How do I set up my investment portfolio for withdrawals in retirement? In this video, we're going to continue with our series on retirement income investing, and I'm going to explain a simple two-bucket system for setting up your investments for retirement. I'm going to talk about how to set up the system, how to maintain that system through time, and I'm going to close the video with contrasting this bucket system with the more traditional bucket system that you may have heard about for retirement income. I'm going to talk about the pros and the cons of each approach and why I think that the more simple two-bucket system makes more sense for retirees. And if we haven't met yet, my name is Mark Walhout. I run an investment advisory and financial planning business called Walhout Financial. I help people with retirement, and I created this channel to share ideas and concepts that I'm using to help people with retirement every single day. If you want to get more videos like these, consider subscribing to the channel and hit the bell icon so that you're alerted when new videos are posted. If you like this video, give it a thumbs up and leave me any questions or comments below. I always love getting questions and feedback, and it gives me really good ideas for videos that I can create in the future. Before we dig into the details of the bucket system, we're going to introduce our favorite retirement couple, Janey and Janey YouTube. They are about to retire. They're 65 years old. They have just about $1 million saved up for retirement. And the way that they look at this money is they want, number one, primarily for that money to generate income for them in retirement. But they also know that they have a couple other needs you want to plan for. Number one, they recently bought a new vehicle, but they expect that in about 7 years from now, they're going to want to replace that vehicle. So they want to have money set aside for that purchase. They also want to have money set aside in a emergency fund. So if something goes wrong around the house that they haven't already planned for, they want to have some money set aside for that purpose. So really, there's two categories of spending that we've identified here. Number one is point in time spending needs, meaning that at some point in the future, they're going to need to take whatever bucket they have set aside for that purpose and tip the entire contents of that bucket over. So for the car purchase, as well as potentially for the emergency fund, they may need to access all the money in each of those buckets at a single point in time. So to me, that's sort of one definition of a bucket, or one set of characteristics for a bucket that we want to set up for their retirement. The second type of bucket that we want to set up for their retirement is more of a perpetual bucket, meaning a bucket that is going to generate for them income on an annual basis. They're going to take a certain amount out every year. The idea, though, is that they won't have to tip that entire bucket over at any point in the future. They want to have that money last them over the course of 2 or 3 decades. So the approach that we're going to take to setting up the portfolio for each of those different types of need is going to be different. And so to help illustrate, I'm going to go to the screen and we're going to show you the visual for each of these different types of buckets. On the left-hand side, we have our point in time spending goal. And as you can see, the nature of this bucket is that they're going to turn it over at some point in the future. And then on the right-hand side of the page, we have their retirement income bucket. And as you can see, they're not tipping this bucket over, but they're putting sort of a faucet on it. They're going to take a certain amount of money out of this bucket every single year. The idea is that it's going to last them throughout their entire retirement. And so you can sort of identify the uniqueness of this bucket when compared to the point in time spending goal. The way we want to set up this investment portfolio is going to be different depending on what bucket we're talking about. So now I'm going to talk about how do we set up the investment bucket for bucket 1 versus bucket 2. And we're going to go ahead and share the screen. And so on the left-hand side, for a single spending goal, because we know at a fixed point in the future, we're going to need to turn that entire bucket over. We have to be very careful about how much risk we take in that bucket. And the table that I've outlined here is from Larry Swedrow's book, Your Complete Guide to a Successful and Secure Retirement, which I've referenced earlier in the series. But what Larry talks about in this chart, it basically identifies the maximum amount of equities or the maximum amount of stocks that you'd want to have in a portfolio that's designed to be tipped over at some fixed point in the future. In the case of Janey and Janey's car purchase, it's 7 years in the future. So the $50,000 portfolio that we have identified for their car purchase, the most we would want to have in equities for that portion of the portfolio is about 40% in equities. The rest we want to have in fixed income and cash. And then each year as that goal approaches, they're going to need to rebalance and reallocate that portfolio. So next year, they're going to be only 6 years away from that goal. So they're going to want to shift the portfolio to be only in 30% equities. The next year after that, similarly, to 20% equities 5 years out from the goal. 4 years out from the goal, shift down to 10% equities. And when they're within 3 years of that goal, they will want to have no exposure to equities. So this is sort of the way that we manage the risk in that portfolio. Yes, of course, we want to get some growth, but we want to avoid that negative outcome where if you have too much equities in the portfolio, the value of that portfolio drops and you may not be able to achieve the objective. It's really about managing risk. And from that previous chart, you'll see that anything within a 3-year time horizon, we have zero allocation to equities. Equities over long periods of time historically have generated higher returns than cash and fixed income, but in short periods of time, they're just too volatile to include in a sort of point in time need. So that particular portion of the portfolio that's allocated specifically to their emergency fund, they would want to have 0% of that in equities. That would be 100% in cash. Maybe you'd introduce a portion of that in a GIC. But again, if they need to get access to all that money at once, they would want to have it in liquid cash. So high interest savings account, cash savings account. That's what we're talking about here. Now, we're going to talk now about the other portion of the portfolio that's going to be designed to generate income for them throughout their retirement. And this is sort of the bucket number 2, and that's the retirement income goal over here on the right. And portfolios here, again, we're not taking out the entire amount in 1 year. We're just taking a certain amount out every single year. In Johnny's and Janey's case, based on the assumptions that we made about future returns and based on how long we think retirement's going to last for them, we think that we need to pull out, or we think we can safely pull out about 3 to 3.5% of that portfolio every single year. And based on their comfort level with volatility, their ability, willingness, and need to take risks that we've talked about in previous videos, their allocation to equities is somewhere around 60% in equities and the rest is in fixed income. Typical portfolios that I see for clients, or that I implement for clients in this particular bucket of the investment portfolio, range somewhere between 40% and 70% in equities. But again, that needs to be sort of measured and decided on a case-by-case basis. And then the big key here is that this needs to be revisited on a regular basis. Number one, the portfolio needs to be rebalanced back to its original weightings on a regular basis, at least annually, if not semi-annually. If equities have risen in value higher than bonds have risen over that time frame, you need to sell off some equities and reallocate some back to bonds so that portfolio stays in balance. And then the second thing is that the capital markets assumptions about future returns are going to change on a regular basis. So we need to consistently come back and update our assumptions about what we think returns are going to be in the future to make sure that if there's changes that we need to make, that we're making them. Because things change all the time. Future returns change on a constant basis as prices in the market changed. So those are really the keys of that simple bucket system. And now I'm going to spend a few minutes at the end of the video here talking about a contrast to the more traditional bucket system and some of the issues that I have with it. And hopefully this helps you as you sort of consider how to set up your own portfolio for retirement income. And I'm going to go ahead and share my screen, and I'm going to talk about the more traditional bucket system that you might be used to. This is one where you have about 2 years of your investment portfolio for retirement in cash. You have about 7 or 8 years, the next 7 or 8 years in bonds and GICs. And then for the years, 10 years and beyond are in equities. And the idea here is that in years where equities are up, you're taking your portfolio withdrawals from the equity bucket. In years where equities are down, you're taking your withdrawals from the cash bucket. And the idea is that over time, you're just simply kind of moving money, from bucket 3 to bucket 2 back to bucket 1. And there's some benefits to this approach. Number one, the biggest benefit is that it is very behaviorally satisfying. The idea that in a market downturn, if the market's down over here in equities, that you don't need to touch these and that you can just simply take your withdrawals from this cash bucket. And you have also the safety of these GICs and bonds for the intermediate years. One of the issues that I see with this bucket when it is implemented is that it's usually not effectively rebalanced on an ongoing basis. And the other issue that I see with it is that sometimes people will create sort of a fixed approach to this and they're not consistently checking back in with the portfolio. So picture this scenario. If you begin retirement and you've set your withdrawal rate at somewhere around 3.5% per year, you've got $1 million in the portfolio. So that means you're taking $35,000 out per year. So you put $70,000 in that cash bucket, and then you kind of sort of allocate your buckets out, to your fixed income GICs into your equity buckets. If you are going through retirement in the first few years of that retirement, there's, the returns in the market are very poor. You have a run of negative years. What you may have not be doing is checking back in with your assumptions and maybe adjusting how much you're spending from that portfolio. This bucket system tends to make people think, if I set my initial withdrawal rate at 3.5%, I can just stick with that and that I can just wait out any bear markets and that eventually the markets will recover. Yes, markets do eventually recover, but they may not recover fast enough to overtake the rapid withdrawals that you're making in the event of a bear market early in retirement. If you're not revisiting those assumptions on a regular basis early in retirement, you may be overspending. Your portfolio may be sending you a message like, hey, we're spending too much money. We need to adjust how much we're taking out here. You should be listening to those messages. So one of the issues with the bucket system is that I think sometimes people have this false sense of security that the market will just continue to give them the ability to take that 3.5% out per year, no matter what. And maybe it won't, and it might get them in a situation where later in retirement they might be risking running out of money. The other thing with rebalancing, I talked about it a moment ago, these portfolios need to be rebalanced all the time. And one of the things that I do see sometimes with the bucket system, the more traditional bucket system, is that people will gladly rebalance when it means selling off equities. But in a year where equities are down and they're taking money out of the cash or the bond or GIC portion of the portfolio, what they should be doing is also reallocating some more money to the equity bucket. But I do see from time to time and hear from people that have, that are implementing the system is that they're not rebalancing and buying more equities. They should absolutely be doing that while that equity portion is down so that they can buy more while equity prices are low. If they're not rebalancing both ways, then the system doesn't work as well. So anyways, there's really no perfect system here. The way that I like to do it, I think, is simple and it's systematic, and it's sort of designed, it's purpose designed for each individual need, both point in time, but also income withdrawals. But as I said, the traditional bucket system does have its benefits, the behavioral benefits. But as long as you're sort of taking care of those other things, I think that the more traditional bucket system can also work. It's just not my preferred method of doing it. So we've talked about objectives, ability, willingness, need, asset allocation. Today, I talked about the 2-bucket system. And from here on forward, we're going to talk about stress testing your portfolio. We're going to talk about active management versus passive investing, big mistakes, and then we're going to close the series with some advanced strategies. So again, thanks for watching this video, and I hope that you have a great rest of your week, and I'll speak with you soon. Take care.